Hello, everyone. Welcome to the Raise Capital Legally podcast and YouTube channel, where we talk about topics of interest to real estate syndicators and fund managers with an opportunity for live questions and answers before we sign off. Before we get started, please note that audio and video from this event will be posted on our podcast platform, YouTube channel, website, and social media, and will be made available to the public. So you can ask questions at the end of the broadcast by raising your hand or typing it in the Q&A. All the information discussed during this event is of a general educational nature and should not be construed as legal advice. I'm Krisha Young, the firm's business development director, and I am so excited to have you share in the wisdom of our very own securities attorneys, Kim Lisa Taylor and Mola Bosland, as they discuss the common mistakes real estate syndicators make and how you can avoid them. During this event, Kim and Mola will share some of the things that have caused their clients' offerings to fail, some tips that can help you succeed. So I'm really excited for you guys to hear the absolute wisdom that is between these two women. And Mola, hi, welcome.
Hi.
Hi.
Thank you. Happy to be here.
You're here. I would love for you to introduce yourself, and we're just going to let everybody know that over the next couple of weeks that Mola is going to be hosting some of these podcasts as well. So we're excited for that. But Mola, go ahead. Why don't you introduce yourself? Hi, Kim.
Hey, hello. Hello, everybody. So I'm Mola Bosland. I've been an attorney for 17 years. I started off in criminal defense and then got into the real estate world when the foreclosure world was crashing, so we all remember that time, and it has impacted people to this day. And from that, my interest in real estate grew, and I became a title attorney and learned how to do closings. So I do have a lot of background with regards to real estate transactions, whether it's for the lender or for individual purchasers like yourselves. And then about 7 years ago, I met the wonderful Miss Kim Taylor, and I've been working with her ever since. And I'm here to answer any questions that anybody would have.
Excellent. Hey, Mola. I'm so excited that Mola's here. She's been kind of like our hidden secret weapon for the firm. She's been here this whole time, but she's been shy, and so we're trying to bring her out of her shell and have her. She's been participating in live events with us, and she certainly has a wealth of knowledge about securities laws. She's got a lot of experience. She's also got a lot of education in advanced law regarding real estate development. So any of you developers out there, she's been really great with our development clients. Anyway, Mola is just, as knowledgeable as me about many of these subjects. So I thought it was a great time to introduce her and then have her kind of take over. Well, some of you might know that I'm getting ready to hike the John Muir Trail. And it's about 211 miles. So I'm going to be gone for like 5 weeks. And so Mola is going to be kind of running things while I'm gone. And so you'll get to know her a little bit more. Any of you who are already clients who've been on our masterminds. So we hold weekly masterminds for all of our current or past clients. And either Mola or I host them along with Krisha. And we want to, make sure that you guys know about those. But that's another way that you can get to know Mola better is she hosts a lot of those as well. Krisha, yes. Has joined our firm how long ago?
I guess about a year now.
Oh wow, it's been that long. Time flies. Yeah. So Krisha is kind of our business development director. She is our business development director. But she also has some hidden talents in helping people kind of get past barriers and mental barriers that they might have. We've done some other podcasts where we interviewed Krisha. Highly encourage you to listen to that. We got a lot of great positive feedback back on that one because, sometimes the mental barriers, I'm just afraid to talk to investors. So she can help talk you through that and get you past those barriers that that are going to get you the goals that you want to achieve. So anyway, Chris is going to ask Mola and I questions today. So we're kind of reversing our interview process a little bit, just so you can hear from us some of the things that have helped our clients really do well, and some of the things that that they do wrong that kind of sabotage themselves. So let's go.
Okay, let's get started. Okay, well, ladies, what are some of the most common mistakes that real estate syndicators make? You've got
Go for
it.
After all these years, the biggest one is not talking to people, right? They wait till their documents are done and they've never introduced the deal to any person. And now you're scrambling before closing to figure out how you're going to raise the money. And more than likely, you're not going to have the money to close, so the deal falls through. You really should be talking to people every day, wherever you go. Tell people what you do. Somebody's always going to be interested.
Yeah, and that's exactly the kind of stuff we talk about on the masterminds is, you know, what you should be saying to people, what can you present to people, how can you approach people, starting with the first time you're introduced to someone and they ask what you do, right? You know, that's where you say your magic statement, or, you know, come up with, you know, just a short introductory phrase that intrigues them so that you can start a natural, organic conversation. You know, handing over your business card, making sure that you have a compelling title so that they look at it. Because most people look at a business card when they get it, look at your name, just kind of you know, remember your name with your face, but also they'll look at your title. So if you have a title that says partner or president or you know, manager, nobody's going to ask what that is, what you do. But if you have a really cool title like, you know, acquisitions director or investor relations manager or something, then they're going to be more interested in knowing a little bit about that. So, you know, so just, you know, having the right tools in place to be able to further that relationship, you know, from the initial first introduction, follow-up conversations, what kind of conversations you should be having with people, when, how do you set those up? That's all the kind of stuff that we can coach you with in the mastermind. And certainly, it, you know, it's talked about in our books too. So, you know, as you know, you may know, I've written 2 books. This second one is a little more advanced. It's a more in-depth version of the first. The first one is more like a step-by-step how to syndicate. That's called How to Legally Raise Private Money. The second is How to Raise Capital for Real Estate Legally. And that one goes a little more in depth into some of those topics. But so let's talk about some other things, because we have a whole list of common mistakes.
Yeah.
New people who are new to syndication often think erroneously that I can just find one investor. I don't have to go out and find a bunch of investors. And so I call those whale investors, you know, like kind of like the whales in Vegas that, you know, the high rollers. These are the high net worth investors. And you'll run into people that are going to say, oh, well, I could just, you know, write a check for this whole deal. And your response to them should be, yes, I realize that you could, but we don't want you to do that. And the reason we don't want you to do that is because, one, you're going to have a job working for them now, which you probably got into this business so you could work for yourself. They may impose a whole bunch of conditions on you that a group of investors would not, and they're going to want some level of control. They're probably not going to let you make as much money as you would be able to if you had a group of $50,000 or $100,000 investors. So the people that are the most successful don't spend any time talking to those people. In fact, they won't even invest with you until you get to 5 or 6 deals done, start to finish. You know, and what happens is a lot of times they're too polite to say, no, you don't have enough experience. So they'll string you along, and you'll be putting all your hopes on that one person, you know, furthering the deal, pouring money in for due diligence, for our legal fees, for your deposits, and all of that. And you're waiting on that one person, and 90% of the time, maybe even 95% of the time, they don't come through. So they're going to leave you at the altar, basically, and they're going to either stop answering the phone, or they're going to say, oh, gee, something else came up and I have to invest in this other thing. And, one of my other projects kind of got in trouble, all of a sudden they go away. Worst case scenario was a client that had a $400,000 investor that didn't show up at the closing table after they'd probably spent $100,000 getting that deal that far. So, it's your money that's at risk, the money of your management team that's at risk until you close the deal. You cannot use investor money until you close on the property. So if it doesn't close, it's your money that's lost, not theirs. And you are obligated to give all the investors' money back without deduction if you don't close on the deal. So don't spend time chasing whale investors. I think that's the biggest mistake people make. And then a lot of them are just scams. They're, oh, we're an investment company out of, Britain, and, just send us $20,000 so we can do due diligence. Well, you will never see them or that money again, and they won't come through. So just don't do that.
Kim, I talk to a lot of people, obviously, and who come through and want to syndicate. And this, what we're talking about right now, not having enough investors, Mola, like what you were saying, is huge. Like it's one of my top questions that I ask people is like, do you have a deal under contract? Yes or no? That's my first question. And then like, tell me about your investor pool. And sometimes these people need like, a few million, right? And they're like, well, I know like 2 people or 1 person or something like that, or I don't have anybody. And that's when I'm like, okay, well, you got to go back 6 weeks here. And, that this is important. It's not something that you can skip over at all. So I'm glad that this was like the number one point. And I just wanted to mention, we can help you create the tools that you need with our in-house marketing department. So this magic statement, business cards, company brochures, things like that is something that we have a unique offering in, because we've got a marketing department that we can hire out, consult and hire out for anybody who wants to, utilize us to create that collateral, because we've got that leading edge with regards to the legal side of things. And so we can make sure that it's going to be appealing to investors and it's going to be, legally sound or defensible, like you say, Kim.
Yeah,
Right.
defensible, but also, everything that we do in-house is going to be reviewed by a securities attorney. We're going to consult you on that. And not only are we going to make sure it says the right things and it's said in plain English, so it's a marketing piece, not a legal document, but we have stellar graphic designers that are going to make you look, really, really professional. And they can help you, with your logo, all that. And so I don't want to make this all about a commercial about us, but these are some ways that we can help you. And we've developed these ways to help people because of all the mistakes we've seen them make along the way, or the inability to find other people that are competent to be able to do those things for you in a timely fashion. It's tough to find people that can write an investment summary for a blind pool fund. Most of our clients write their own property packages for their syndicates, and specified offerings looks a lot like an offering memorandum a broker would give you, but we review them to make sure that they're all consistent with the legal docs we're drafting. So boy, we've got a whole long list of things.
I know.
So maybe a little less long-winded, right? So Mola, why don't you tell us another that you see?
Yeah.
Another one that I see is that people are so desperate to avoid securities laws that they come up with all kinds of confusing structures, and you spend more time trying to put together these things to avoid securities laws, where it would have been a lot simpler for yourself and your so-called partners or investors to just do a securities offering. You're not avoiding trouble, you're creating more trouble than it's definitely worth. So that's another big thing that we do see from people that have come and they're like, oh, well, we've raised money before and we've done it this way. And after a while, you're like, just following this law is a lot less complicated than what you're trying to give your investors back.
Well, and yeah, you're absolutely right about that. That's an excellent one, because we see a whole lot of people trying to do joint ventures. If you get to more than 5 people in a joint venture, you're not doing a joint venture. First of all, there's not enough jobs. for everybody. And in order to be a joint venture so that you don't have to comply with securities laws, you still need to have an LLC, you still need to have an operating agreement, but it's a member managed LLC, which means that by law, every single member is a managing member, has the ability to open and close bank accounts, contractually bind the company, and do all things related to that company. Well, you don't want 10 people doing that. 5 is the max we've ever seen function correctly. Anytime you get to 6 or above, they become very dysfunctional. Everybody gets very dissatisfied. There's not enough jobs. There's not enough money to go around. So 2 or 3 people end up doing all the work. The other people are dead weight. They're just hangers on. They're sucking up the income, and the other people are spending hours and hours every week trying to make this deal viable. So you have to be cautious about admitting too many people and trying to make them all active members. What the distinction is that when you have passive investors, that's when you're in the securities realm, because you've created a situation where you have passive investors that are relying on you to generate a profit for them. That's called an investment contract, and investment contracts are securities, which triggers having to comply with securities laws. What does that mean? You have to have a private placement memorandum if you have any non-accredited investors at all. We highly recommend it if you have more than 4 or 5 even passive investors. You still need to have the operating agreement, but the operating agreement and the company is now manager managed. So the manager makes all these decisions, does all the things. And again, your manager entity, it's a separate entity. It may be a joint venture, but it's, where all the members of the management team are actively involved. But again, you should never have more than 5. 2 to 3 is the ideal situation. Those are the ones that seem to be the long-lasting clients that come back to us again and again and keep doing deals, are the people that only have 2 or 3 people in management. That's you can't avoid securities laws if you're going to try to scale. If you want to stay with joint ventures, you're going to have to do a bunch of small deals. If you want to get bigger and you want to be able to raise millions of dollars, then you need to be able to understand and comply with securities laws. And it's not that expensive. You're going to raise enough money from your investors to reimburse yourself for the legal fees. And so it's an insurance policy for you, because in the private placement memorandum, we're going to describe all the different things that could go wrong, the risks of investing. And if one of those things happen, you can't be held responsible for it. The investors assume the risk when they read the PPM, when they complete the subscription agreement that says they've read the PPM, said they understand the risk, that they can afford to lose the money. And now, you're absolved as long as it's not something you did that was illegal. Steal money, you're going to go to jail. Period. Bottom line, you'll eventually get caught. Just don't do that. So anyway, don't try to avoid securities laws. Learn to use them as a tool so that you can scale your business, and you will be able to go far in this business. But then that's back to Mola's original point. In order to scale and grow this business, you have to have ideally a group of 50 to 300 investors that have been pre-vetted, that you've established relationships with, that you've talked to them about their financial goals. You understand what kind of deals they would be suitable for and what wouldn't work for them. You understand whether they should, be invited into management because they know people or because they can help you guarantee loans, or if they're just going to be passive investors. Those are interviews that you should be having with people right now before you have deals. And again, that's the kind of stuff that we talk about in our masterminds and coach everybody on for making sure that you create that database. We did have a client one time that came to us. They had 2 deals under contract, put up $75,000. Ended up losing it because they didn't have a single investor. They at some point relied on someone else who said, I can raise all the money. They didn't raise anything, and they ended up losing that money. So, it is a real issue. If you want to succeed, you've got to talk to people. Now, if you don't like talking to people, you better have someone on your team that does. Okay. Yep. You need a salesperson. You need someone, ideally someone with some sales background or some previous experience in the financial services industry, or somebody who just likes getting out and networking and going to events and, going to golf tournaments and talking to everybody about what they do. That's the person that you want to help your kind of leading your capital raising effort. So, okay, cool. What else?
Yeah.
Let's see.
What about timing?
Well, with timing, we get clients that wait till the last minute before they show up at our doorstep. But the ideal timing to hire an attorney to do your securities offering documents should be when you have signed the purchase and sale agreement, you have walked the property, and you have reviewed the financials. That way you are most likely to start moving forward with your project, right? We have clients that call and say, we are closing on next Friday. Can we get docs? Well, the time that it takes to do your documents and for you to actually collect the money from your investors, you're not going to have enough time unless it's like an all accredited offering. You don't need a PPM, and it maybe have like 2 or 3 investors. That might be a little bit possible, but work on your timing. And your timing becomes very important, especially when you're doing that purchase and sale agreement, depending on the asset that you are buying. You want to have enough time when you do that purchase and sale agreement that you have time to do your due diligence, and sufficient time from the time due diligence period ends to before the closing. Because we normally do your documents during your due diligence period. Does that always happen? No, but that's the ideal time, right? That's what we would really love to do during your due diligence period. You see time-wise, maybe sometimes between 60 to 90 days. 90 days is amazing because it also gives you time to do your due diligence, start talking to investors, getting soft commitments. And then by the time your documents are actually finished, if you've done this according to those steps, you may not have to do anything else but send out your documents to all the people you've already spoken to and have the money wired in. We do have a lot of clients that do that, and those are our most successful clients, that they literally know every investor that's going to invest by the time they have received their final offering package from us. So that is just something to think about. That timing is very important, not just on the end of getting your documents done, but making sure you have everything you need done internally with regards to closing on that property.
Well, and the flip side of that, those are amazing points. That's exactly what we see time and again. Okay. But the flip side of that is people who go out and raise the money before they have documents. Okay.
Yep.
That's a ticket to jail. Okay.
Yep.
Because you don't have the right company set up. You don't have the right documents set up. You're not giving them the right contractual agreement between them and you as to where the money's going to go. A worst case scenario, we've seen people put investor money into their personal bank accounts. Okay. That will land you in jail. You will go to jail for that. Or they put it in some other, company that they own that owns other stuff and has done a bunch of other things. And, that's completely inappropriate also. So you've got to wait to collect the money until the investors have had an opportunity to review your offering package. So when we talk about an offering package for a securities offering, we're talking about a private placement memorandum, a subscription agreement. Those are your securities compliance docs. Okay. And then an operating agreement for the investment level LLC. Sometimes that's also the title entity. Sometimes we have another entity that owns the project that the investment entity owns. And then we have a management entity. You don't have to share that operating agreement with your investors, but you need to have it in place so that you and the other members of your management team have an agreement as to how things are going to move forward and how who's responsible for doing what, just to get things done. You're creating a company that's going to, same thing as if a company was creating a new product or a service. You'd have to have a management team in place that's going to do all the stuff necessary to get it done. It's the same thing. You're just buying real estate. So, the package again, PPM, operating agreement for the investment level LLC, subscription agreement. And then we do some filings with the SEC. One's called a Form D. And the way that we handle those for our clients is we file those as soon as we give you the final documents and you're ready to go out and raise money, because we want to file that with the SEC before you've raised any money. You do have a 15-day deadline from the first time you raise money, but we want to make sure we don't miss that deadline. So we want to get that in. And then you also have to file notices in with the state securities agencies based on where your investors come from. So when you start admitting people to your company, you have 15 days to file these securities notices from the date their funds become irrevocably contractually committed. For the documents we write, if it's a syndicate, that's going to be the date you close on the property, because you're not going to admit anybody till that date. And it's going to hold their funds in trust, realizing if you don't close, you're going to give them back. And if you do close, then you're going to admit everybody that day and use their funds to close on the property. That's going to start your filing deadline for all those investors that invested before you close. What about the investors that come in after you close? Because you can keep raising money after closing. Well, those investors after you close, their 15-day deadline starts as soon as you receive their funds. And then you admit them to the company. So you admit them by them filling out a subscription agreement, sending you their money, and then you have a receipt and acknowledgement page on the subscription agreement that you send back to them that says, okay, we accepted your funds, you're admitted. And from the date that you send that document back. Now, if other people have drafted your documents, you may find that they have not accounted for the fact that you don't really admit people till you close on the property. So they're going to say, you've got to start filing those notices as soon as you receive funds from anybody. And we've had clients that have come to us before and said to us, oh no, we've used you guys in the past and then we went somewhere else. And now they're telling us we have to start filing these notices all at once. And, we look at the docs and say, yep, that's what it says. And then they came back to us and said, we will never use those other people again, because that's not what we want. We want to be able to make sure that we're going to close before we have to start shelling out money. Securities notice filing fees are anywhere from $150 to $1,200 per state. So if you're raising $3 or $4 million, you could have $3,000 or $4,000 worth of filing fees, depending on how many states your investors are from. But that is a big mistake that a lot of people make. They miss the deadlines, or they don't tell us when they closed on the property, or they don't tell us when they brought in new investors. And so we can't file. So we do the filings for you, but you have to notify us within the timeliness that we can get them done within those deadlines. States are cracking down on this. We have seen letters coming back from the state securities agencies saying you missed the deadline. We don't have a late filing provision. We could charge you 20% of the offering amount as a fine.
Wow.
Okay. But this time we'll accept a $150 late fee. Okay. What if you do it again? Next time they're not going to be so lenient. Other states have said, you missed the filing deadline. You don't get the federal exemption in our state because you didn't comply with the rules for our filing deadlines. Therefore, tell us what other exemption within our state you complied with. We had a client one time that we couldn't comply with it they couldn't comply with it because they didn't do anything that would have complied with the state rules for that exemption. So, it can become very cumbersome. You can get fined, you could get, banned. If you do things really, really wrong and you do it wrong a lot, you could ultimately end up being barred from ever raising money again, either by getting a state regulatory order, a cease and desist order, or a federal cease and desist order that just says you can't do this anymore, you're not following the rules. So if that ever happens to you, then you could be barred from ever raising money. So, for getting securities notice deadlines, that's part of your timing, as well as making sure that you're hiring us in time to get the documents done and you're not raising money from people before. So you can talk to people, you can get people to tell you how much they might be willing to invest. You just can't collect funds before you have the documents done. Give yourself enough time to do that.
Yeah.
Yeah.
That's great.
Yeah.
So what are some of the key factors, can you share some examples of issues that have caused your clients' offerings to fail?
I can start.
Yeah.
People that have done funds have over-diversified the fund, and then it becomes not attractive to their investors.
What does
So
that
the fund, So they basically threw in the kitchen sink. We're gonna buy multifamily. We're gonna lend money. We're gonna joint venture. We're gonna do all these things with your money. People don't want to see that. You know, so that becomes an issue. We've had quite a few clients who did not agree with our suggestions, and we've had to reconfigure their documents, and they've come up with a whole new purpose to redo their fund because they were not able to raise a dollar. People were not interested in a fund that does too many things. If you're going to be, because it's a business plan, right? A fund is truly a business plan. We don't necessarily have you may not necessarily have the first asset that you want to put into the fund when you are starting the fund. We do recommend that you do have at least one property under contract to put in there so people understand that this is what you are using their funds for. But a lot of times people do not. And you're selling people on your experience, not only in the real estate world, but also your experience on managing other people's money. And right now you have a business plan, not saying we are buying this specific asset, right? It's a lot different than raising money for an identified property. So when your fund does too many things, they're like, well, how can I really trust that's what you're doing with my money?
Yep, I 100% agree with that. I call them kitchen sink funds. They're going, we're going to do self-storage and retail properties and multifamily and some single family fix and flips and subdivisions and developments. And, every single time you add a new thing to your offering, as far as what you can do with the money, the investors start to think, first of all, well, they can do whatever the heck they want with my money. And I don't want that because I don't know that they have experience in all those areas. And most people don't. And, so they're only interested in investing in a fund where you have a demonstrated track record with the same asset class with investors. So the best thing you want to do, if you want to do a blind pool fund, so let's just kind of back up a minute. Syndicates, we're buying one thing, we already have it under contract, you know exactly how much money you need for it, you know how the money is going to get spent, you can do pro forma for how that property is going to perform over the next, however long you plan to hold it, and then you can have a proposed exit strategy. You're going to make some assumptions about what the cap rate is going to be in the future, and you're going to make some value add improvements, you're going to increase the net operating income, and increase the value of the property, sell it, pay off the loan, you'll have some equity left from that, probably doing cash flow distributions in the meantime. And, that's your syndicate model, right? A blind pool fund, on the other hand, is we don't have anything under contract. Here's what we're going to buy, and here's our business plan. So we're looking for these kinds of properties in these geographic areas. If they meet this criteria, we're going to go ahead and buy them. Here's the members of our team. So it's the difference between investing in a startup company that has no paying clients, which I don't recommend. Ask me how I know that. And investing in a startup company that has paying clients. They've already developed a product or service. They already have paying clients. They're on the trajectory to grow the company. They may or may not succeed, but it's far more likely that they're going to succeed than the one that never had a paying client to begin with and just had an idea. And then maybe couldn't get it accomplished, or just didn't raise enough money to get there. So anyway, that's that's the difference between a fund. And so funds have a kind of a negative connotation in that people are nervous to give you their money until they see a concrete use for it. And that's where to Mola's point, if you have a fund and you want to get people to give you money, then get a property under contract. Even with a fund, it's a fallacy to believe you're going to do a $5 million fund and you're going to go raise $5 million and then you can shop around and spend it however you want. Okay. Never going to happen. Never will happen. But what will happen is you're going to raise the money as you need it. Investors will sit still for about 90 to 120 days, giving you an opportunity to put their money to work. If you haven't done it by then, they want their money back. They're going to invest it somewhere else. So if you can't deploy the money within 90 to 120 days, don't raise it. So with a fund, you end up raising in tranches as you need the money, as you have deals to deploy it on. So the only reason to do a fund is because you have so much deal flow, you don't have time to stop and get the docs done and you have a tremendous track record with your management team, it doesn't have to be you personally, but it has to be within the management team that everybody says, yeah, these guys, these people are capable and competent enough to get this done. So that's kind of my thoughts on all of that.
Mhm.
Cool. Yeah.
What about using bridge debt?
So you want to talk about that, Mola? Or you want me to?
You go ahead, because we do have a
Okay.
lot of clients who do use bridge debt.
So yeah, we have a lot of clients that have used bridge debt. It's a risk. Okay. The risk is that you're going to use bridge debt, and then these bridge debt loans typically have maybe a higher interest rate, shorter maturity date, and if you don't refinance out within a certain period of time, then they get to take over the property. And so what happens, and so we saw this happen in the last recession in 2008, 2010. We saw a whole lot of people that had short-term debt, 3-year maturity dates. They got caught when the prices were depressed and they couldn't refinance the property for the loan amount because the property was worth less than the loan amount. So they ended up giving properties back to the bank. The banks would repo and then sell them for a lower rate just to recoup whatever money they could. Now what we're seeing is that people got into these short-term debt and all of a sudden the interest rates hiked. So all their projections are wrong because they were making projections 3 years ago based on what the interest rates were 3 years ago. Now the interest rates are double or more. And in order for them to refinance that property, now they have to pay a much higher rate. Their net operating income can't sustain the additional loan payments, and the property values are depressed because of the fact that the more you have to pay in interest, the less people are willing to pay for your property because there has to be an offset. So that's one of the reasons we're not seeing a whole bunch of deals right now, is because the sellers haven't reduced their prices enough to accommodate the interest rates hikes, and then the people that have the bridge debt are now in a spot where they have to bring in additional money to be able to get a refinance loan. So that is possible. There are rescue funds out there. If you need help with that, call us. We can help you restructure. We can help you do capital calls. We can help you, review your docs, whether we drafted them or not, and help you craft a letter to your investors. We've had some clients that have done capital calls, and what they've told us is that phone calls are critical to the success of your capital call. They said they wrote a letter, here's what we're doing, and they called every single existing investor one by one and said, here's the need, here's what happened, here's why we need the money, and they had 100% compliance. Those that just send out, hey, we need some more money, here you go, here's why, they don't have very good compliance. So you'll get, if some of your investors will say, okay, we'll do it, others will say no, and then you're scrambling around for the rest of the money, from the people that don't. We don't write docs with punitive provisions if you don't do a capital call, because a lot of people won't even invest in them if they see that. We have voluntary capital calls, but we also give our clients the ability to then go out and raise money from new investors or even priority investors if they had to, in order to salvage the investment. So just be aware, whatever your docs say is whatever you're going to do, but make phone calls to your investors, explain to them what's happening, and they will very, very, very much appreciate that, much more likely to comply with your capital call, and create a little presentation for them. Just like your initial property package, you're going to create a new one. Here's what we did. Here's what we said we were going to do. Here's what happened. Here's where we're at right now. Here's the need. And let's go for it. Now, why do people do bridge debt? Because the property doesn't have enough occupancy to get Fannie or Freddie financing up front. And usually that's why, it needs too much renovation. It doesn't have the right occupancy. It won't meet the Fannie or Freddie criteria. And the Fannie Mae and Freddie Mac loans are the best for multifamily. They're not available for other asset classes. So then you're looking at, traditional CMBS loans, commercial loans, and you have to meet their criteria. If they don't, whatever reason, say we can't do it, then you have to use the bridge debt. But if you're going to use bridge debt, make your loan maturities as long as possible. If you have to do a 3-year bridge debt loan, try to build into a couple of 1-year extensions. even on your regular first position institutional loans, get long enough maturity dates that you can ride out a wave. So if we have an economic downturn, you can usually ride it out if you can, if your loan maturity is 7 years. May not be able to ride it out if you've got a 3-year maturity date. Even 5 can be sometimes challenging, but 1 or 2 year maturity dates are very, very scary. So yeah, that's a good one.
Wow. Okay. Anything else to add, Mola, on that one?
Nope. Just, make sure you really read your loan documents or have someone like your real estate attorney help you read those loan documents. That is another issue that we do see, regardless if it's bridge debt or conventional lending or agency debt. They don't know what the terms are in their documents, so they get surprised. Beyond all they know is, oh, we have this interest rate for this long, and they don't know what else can happen after that. So it is really important for even you to look at those documents and ask those questions. Well, what happens if we get to this point? Ask your real estate attorney, because that's normally who is going to help you through the transaction with those loan documents.
Okay.
Yeah, that's true. That's very true. And especially, I just want to mention adjustable rate loans, right? A much safer position for you to be in with your syndication is pay whatever it costs to get a long-term loan or to get a longer maturity date. If it costs more, too bad. That's the cost of your syndication and the way that you're going to protect you and your investors' money. If you lose your investors' money, your reputation is going to be significantly harmed. You may not be able to do this business again, depending on what happened. So, you have to be very, very protective of them. So, okay.
Wow.
You can see we have quite a few questions.
Yeah,
Do you want to mention something about the books, Krisha, or
I can totally do that. Absolutely. All right. So we do have 2 books. Kim mentioned these at the very beginning. I love demonstrating these on calls. This one here is our first one for beginners. It's like sits the really great foundation here for you if you're just starting out. And this one here is for people who are a little bit more experienced. It goes into depth there. You can get these books for free if you text the word syndicate, SYNDICATE, to 844-796-3428. So that's texting the word syndicate to 844-796-3428. And you can also get this on our website at syndicationattorneys.com.
Yep, there's a free book tab there, and so what's going to happen is when you get there, or if you do the syndicate text, and the phone number actually spells syndicate. It's 844-SYNDIC and the number 8. So if you can remember that, we know a lot of people are going to be listening on audio, so we'll try to make it easy for you. But at the website, syndicationattorneys.com, there is a free book tab. And if you go there, then you're going to be asked a question, and one is going to be, have you raised capital before? If you say no, we're going to send you the first book. We're going to send you a physical copy, so you give us your address. And if you say yes, then we're going to send you the second book. And if you've already got the book or you want it on Audible, then you can go to Amazon and get the book there as well. So at Amazon, you can get Kindle, or you can get either Kindle, or the second book is on Audible. We're actually going to be updating the first book, so we should have a second edition coming out sometime later this fall. But right now you can still get the first book, the first edition of it. So
books are great. Like I'm in them every day. They're fantastic resources. Okay, so before we get to the Q&A, what are some of the key factors that contribute to a successful real estate syndication? And we've got like coaching and training and having the right team members. So what do you think, Mola?
One of the things I think, especially if people that have started out with like joint ventures, even if you're new, be open to listening to what we as the attorney have to say, right? Because sometimes you may have these plans on what you really want to do, and they're not realistic, right? And we can tell you that. We can say investors are not going to like that. People are not going to be interested in a deal like that, regardless of it, how well you try to sell it, right? So I think sometimes people have to learn. I know you want to do what you want to do, but you also have to be open to advice that some things are not going to be interesting to other people. Like we've had a client before, their deal was a 10-90 split. They were willing to give investors 10% and their take was 90%. How many people do you really think want that type of return on a massive, it was like some massive country club multifamily development that had like all these different things. And I mean, basically the syndicator was pocketing all the money. People didn't want that, right? And when we told him, hey, people aren't interested in that. They want to be able to see how their money is supposed to grow and from the investment on that. So keep an open mind if we do tell you, maybe look at it from this perspective, right? Because sometimes if you look at your deal as like an outsider, maybe as an investor, would that be something you would want to invest in?
Yeah.
Mhm.
Yeah, I think that's really great advice. Just in this book, this is the second book. There's a chapter 17. So any of you that already have it, is your offering viable? Okay, so that's where we talk specifically about crazy schemes don't work. In fact, I do see a lot of crazy schemes. Usually I get a weekly bulletin from the Securities and Exchange Commission on all the different offerings they've filed lawsuits on. And they're usually some crazy scheme. And it's amazing that people were able to invest to raise any money at all, but they were. And then it didn't pan out, and that's how they end up in trouble. And those people usually end up going to jail. So I think what things do make our clients successful, though, having a coach. All right. If you're going to buy real estate, you need training in the asset class that you're going to buy. All of our most successful clients have come through somebody's coaching program. And not all coaching programs are created equal. So do some due diligence, listen to some YouTubes and some videos, find out who you resonate with, ask about their experience. How many deals have they done specifically? Because a lot of people just teach, they don't do. So make sure that the people that you are following are people that you can actually resonate with, and they're doing the kind of asset classes you want. And they're teaching it well, and that they have enough content, right? Because if they don't have enough content, then you're not going to get much out of it anyway. So having a coach is critical to your first 2-3 deals. And it doesn't have to be a paid coach. It could be a mentor. Maybe you're going to, team up with somebody else. If you want to team with experienced people, you have to offer them something that they don't have. So you either have to be really good at raising money and have investors, or maybe know a lot of people with money, or you can help guarantee loans, or you're really good at underwriting, or you're really good at overseeing property managers or something like that. So develop your skill set within the syndication realm, and then shop it. Just go out and create your resume. Hey, this is what I do. This is how I'm really good at this. Let me on your team and I can do it for you. There's a lot of people that need underwriters, capital raisers, loan guarantors. And that's, again, you don't want to keep harping on our masterminds, but we have actually created a community for our clients called Circle, where it's just a clients only community where people can post their wants and needs and post their resumes and, what they're looking for as far as other management team members, and get to know other clients that could team with them on deals, or who they may be able to team with if they want to get some management experience. So get a coach, get a mentor, get on somebody's team that's already doing it, who's going to help you learn how to do it. You'll do that for your first 2-3 deals, and then you'll know how to do it yourself. And then you can launch out, do your own thing. The whole co-GP capital raiser model, I'm not a fan of that. It's the only reason that you should be doing that is as a stepping stone until you can gain enough experience and find your own deals. You don't want to do that as a sustainable business model. It's not sustainable. Eventually you're going to get caught. Somebody's going to accuse you of acting as an unlicensed broker, and you either have to become an investment advisor to be able to legally do that and invest in other people, have your clients invest in other people deal under other people's deals. It's just not a long-term sustainable business model. If you want to know more about that, what I'm alluding to is something called a fund of funds. Fund of funds is, like I said, it's an okay for a first 2-3 deals. Go ahead and bring your investors to somebody's deal, and we can show you in this book. There's just chapters on how to do that legally, how to do it the right way that's not going to land you in trouble with securities regulators or require you to become an investment advisor. But that being said, if any of you wants to do a fund of funds, you want to be able to, repeatedly raise money, invest in other people's deals, you can become a registered investment advisor. And we just added another attorney to our team who can help you set that up. So her name is Judith Villarreal. So we'll introduce her at some point. But yes, reach out to us if you are wanting to create a fund to invest in other people's deals. You need to talk about compliance with investment advisor rules. Then Judith is a resource for you, and we're super excited that she's joined our team. So let's see, discipline. Yeah, this is where a coach can help you. They're going to make sure you're doing the right things all the time and not doing the wrong things. Don't go chasing after stuff. I mean, I met somebody one time who'd gone through a multifamily training course and then came to us and said, we have ski area under contract. Like, okay, well, what do you know about ski areas? And so if you're going to do ski areas, then you better bring someone on your team that knows about ski areas. So you team up with somebody that does that. That's fine. If you don't have somebody that does that, chances of you succeeding with that and chances of you spending hundreds of thousands of dollars and not getting anywhere with that are pretty good, pretty great. So we need to go to Q&A. We've got too many people waiting online. We've got to.
Yeah, we're going to move over there now.
Okay.
Well, so Steve Brown is asking if he should have a consult with us, if he should wait until he finishes the book to ask specific questions, or if it would be better to get on a call now to discuss the situation and get general guidance on whether he needs SEC filings or qualify for an exemption.
Okay, talk to Krisha. Krisha is who you need to talk to. She's going to tell you about the different services and options we have. We do have a low cost entry level program for people that don't have deals yet, trying to figure out what they want to do, and gets you into our masterminds so that we can start coaching you, get you some one-on-one consultations to help you strategize and get to your goals. So that's really what you want. It's called our pre-syndication agreement. So Krisha can tell you all about that.
Yeah. You can email Krisha at syndicationattorneys.com. All right. So Vinky has a question. When you have a 3C5 RE fund, do you need to disclose your co-GP compensation to investors in any disclosure?
Well, you need to talk. Yeah, I think you do, because you never want investors to have anything that they could say later, I wouldn't have invested if I'd known that. So if you tell them everything up front and they don't object to it, then they've consented. And if later on they're like, oh my gosh, I had no idea that you were getting all this management, this money from the management team and blah, blah, blah. Well, they won't care in the beginning. They'll use it as a gun to your head in the end if they want to get out of a deal. So better to disclose than not disclose. Put it in your PPM and that this is how much I'm going to get compensated if you know what it is. I mean, sometimes it's just, hey, I'm going to get compensation. I'm going to get a percentage of the management earnings. I'm going to get a percentage of the management fees. It's impossible to know how much money that is at this time. Just want you to be aware of it. And it could be substantial. If you have any issues with it, then, either don't invest or give me a call. So yes, disclose. Anything an investor could say later, I wouldn't have invested if I'd known that. You put in the documents.
Yeah, better be safe than sorry, eh?
Mm-hmm.
Yes. Yeah. Van C asked, does the legal package with you include the creation of the management agreement if we do not yet have it in place?
Absolutely.
Absolutely.
Yep. And in fact, we want you to do that. So we are corporate securities attorneys. That's another mistake that people make sometimes. They'll have an agreement with somebody else where it's like, oh, we get all these unlimited LLCs. We'll just have them do all of our LLCs. Yeah, they don't do the same kind of LLCs that we do. Ours are very, very specific for your intended purpose. Our documents are constantly evolving over the based on the real experiences of our clients. They've evolved very significantly since when I started doing this in 2008, and even more so since I started this firm in 2016. So no, you don't want other people drafting those documents for you. Don't let your real estate attorney draft, or a different attorney who's not a corporate securities attorney draft those docs. And whoever you choose to be your corporate securities attorney, we want to draft all of them because we're going to make sure they all fit together. They're all consistent. There's not inconsistencies. And we're also going to be giving you advice about who should and shouldn't be admitted to your management team. And this issue has just come up this week. You never admit your asset management entity into management of a syndicate, because if you do, whatever assets you own in that entity are at risk if you get sued by investors. So you never want that. There is a place for it in your syndicate, but it's not in management. So just beware that when you come to us with these other documents in place, often it costs us more to fix them if they can be fixed than it does to draft them right in the first place. So no, we want to do your whole corporate structure, and don't let other people get in the middle of that.
Mm-hmm. Do you have anything to add to that, Mola?
No, because Kim's got that right.
Yeah.
You learn from the best, right?
Yeah. All right. So Jesse is asking if you could recommend some good coaches. You mentioned that earlier today, Kim, if it's okay, or people can email me and we can get a list out.
I'm happy to talk about the people that we have relationships with, because they've been tried and true in this industry. They've been doing it for a very long time, and we've had a lot of successful clients come out of these groups. So we know that they know what they're talking about. So Ari Mentor is definitely one of them. That's David Lindahl. Their coaching program, we probably get more people from them than any other because they've been doing it longer than any other, and also we do a lot of training for them. I co-teach, Mola and I actually both co-teach their private money boot camp. And so we're kind of integrated with that team, but that's they're not the only team that's doing this. Jake and Gino are phenomenal also. Vinny Chopra, long-term client, syndicated 26 properties. Listen to the podcast I've done with Vinny in the past. So he's got a coaching program. Who else am I missing? I know I'm missing some. Stacy and Jen Conkey. They're the only women that I know that are teaching this. They have kind of I think that's more of an entry level where people are kind of just getting started, graduating from joint ventures up to some smaller multifamily. But if that's your comfort zone, they're a great fit for that. They're amazing. They put on a really great show. I actually chopped a board on the stage. Yeah, so they're super motivational. Who else am I missing? I know I'm absolutely missing people. There's a lot of people. And check out our trusted vendors page on our website, because and also check out our podcast, because the people that we regularly interview on our podcasts that have real estate training programs are people that we know, like, and trust, and that have done great things for our clients in the past. So those are the people that we invite to be on our vendor list. So if you go to syndicationattorneys.com, there is a vendor list there.
Yeah. All right. Well, we have 1 minute left, Kim.
Okay. Well, I just want to answer something that Jesse asked. Can you put Judith's full name in the chat? Jesse, just reach out to Krisha at syndicationattorneys.com, or you can schedule a call with her, and she'll figure out what you need and get you on a call with Judith. Yeah. So that's perfect.
Yeah.
So.
Yeah. What an amazing episode.
Yeah.
There's so much information here. And, I think it's like anybody new to this, just like really take on board what Mola and Kim said today. Like just walk before you run, really dot those I's, cross those T's, because this is a new business that you're starting. And at the end of the day, we want you to be really successful and, legal at the same time, and we're here to really support you through your venture and, like cheer you on and, but help you do it in the right way.
Yeah. And so the first step for getting involved with us, go to our website, syndicationattorneys.com. There's a button on every page that says schedule an appointment. Just click that button and you can either choose a paid consult. We're going to be putting Mola up there. So me or Mola or Krisha, and we'll go, we'll figure out what you need. And, Charlene too is another member of our business development team. So a lot of you guys already know her. So you can have a call with any of us. And we're happy to help you guys move your business forward. Paul, sorry we didn't get to you. We kind of ran out of time. I guess we talked too long. Me.
Paul, send us an email.
All right. Thanks, everybody.
Bye, everyone.
Thanks, Mola. Thanks, Krisha.
Thanks, Mola. Bye. Bye, Kim.